You're with us here on a fresh new edition of Taking Stock. This is the show where we actually look back at the week which has gone by, take stock of what has happened, but more importantly, as always, try to tell you what will be important to watch and what won't matter for the next coming 5 days. I'm Prashant Nair. With me, as always, is my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Interesting week for the market. Short one, but one where I guess bulls managed to retain charge despite all the ups and downs, the global volatility, the Turkish issues, the lira crash. There's so much going on, bad trade deficit numbers. So just a very quick recap. This essentially was what it was all about, trying to put up a brave front in the face of a lot of this international news flow that we were getting. Largely speaking, the Turkish issue. So currency was the biggest talking point, and the Indian market has seen the rupee cross 70 this week. Despite that, we're down just about 0.5% for the Nifty. We're sort of in that ballpark range, almost taking aim at 11,500. The interesting facet is that the headlines were negative with respect to what we were getting on the trade deficit front as well. 5-year highs for the July trade numbers. So those were some talking points. Now, despite that, if we look at what happened in terms of stock movement, rupee plays were in vogue. So IT stocks, pharma stocks, they did really well. And interestingly, the PSU bank rally in the first half, it looked like it was getting kind of steamed out, but towards Friday there was a pickup over there as well. The other interesting facet is mid caps are still getting lots of buying. The mid cap index has outperformed the Nifty with a gain of about 1.5%. I'll just end with some examples of the kind of stocks that have rallied this week. So on the mid-cap side, Apollo Hospitals, United Breweries, some of the paper stocks have done really well, fertilizer stocks. So there's a lot of interest in this side of the market. And the large caps, Prashant, as I was saying, I think IT, pharma, even some names like Hindustan Unilever. So fair amount of diversity in terms of participation this week.
Oh, yes. And, so let's look ahead, as we always do. And this is how things are set up, and we're looking at some sort of a mix of currencies, commodities, everything. I mean, what goes into the mix for one to be able to intelligently not predict, but gather which way the wind is blowing. So, I mean, first up, something which has not been focused on that much, which is essentially the euro. The euro dollar has broken major supports. The only reason I'm highlighting is this is because it's not just a function of the dollar. When we usually say currencies are selling off, you say, well, the dollar is being bid higher and that's crushing everything else. But you can look at the euro against any other currency, G10 currencies or emerging market currencies, actually more G10 than EM, the euro is selling off. It looks like the trouble is not just the dollar strengthening, but the euro itself has got some issues of its own. So keep an eye out on that one. I mean, so far when we've talked about these, these mini episodes of crisis, we've not really spoken about Europe for a long time. Maybe that will come into the forefront. Watch out where the euro really goes. Euro USD, of course, is the most widely tracked pair. The dollar is strengthening, and I think there is no confusion about that. It's going from strength to strength. It was sort of flat since, I think, middle of May, but it started to pick up steam once again. That never really is great news for emerging markets. I mean, stocks or currencies for that matter. That's point number two. Look at industrial metals. You could look at the LME index or the Bloomberg Industrial Metals Index. It's coming under pressure. I hope we could have showed you graphically, but it's looking weak. I mean, take metals like copper, for example. So again, it's got implications for stocks from that space here in the listed universe. Look at oil, and I think that is a silver lining by far. It is, and we sort of noted this many weeks ago that maybe a top is already in for oil, and after cracking in the initial part of the week, it's not rallied again. The initial supports are at about 63.59 on the WTI. Gold, I mean, who wants to talk about gold nowadays? But it's continued to struggle, and there is no sort of reason to expect that things are changing there in a hurry. The S&P 500, which I've sort of pointed to earlier as well, which is the Pied Piper. And, had we been putting this out yesterday, I would have said that it's concerning that the S&P is starting to fail, and it's not taking out its all-time high, which is at 2873. But we got that rally on Thursday, and maybe it actually does get to its all-time high. So the bullish thesis on the big market, the Pied Piper for global equities, continues to be pretty strong. Just this last point, look at the MSCI Emerging Market Index. This is all dollar terms. It's down 23% from its all-time high, which essentially means that in classical terms, it's in a bear market, the MSCI EM index. But look at the Nifty in dollar terms. It's down about 7.5% from its all-time high. So, I mean, even as, you know, currency-wise and equity-wise, emerging markets are starting to come under some renewed pressure. The Indian market, and I would say even the Indian currency, it's down about 10% this year, but, well, many other currencies have had it much worse. I mean, the India story is still holding on, is still looking quite all right. The big thing is oil stays where it is, and US markets continue where they are, maybe even make a new high in the coming week. Surabhi.
Okay, so that's the setup. Now joining us to discuss the markets and the way forward, we have this week with us Mihir Vohra, Director and Chief Investment Officer at Max Life Insurance. Mihir, thank you for joining in. Good to have you on the show. So we're at interesting times. The market has moved to almost back to all-time highs. You know, how do you look at a lot of the macro issues that we've had to grapple with this week, whether it's the rupee, the current account deficit, a lot of the global headwinds that we've heard of? Could they derail the rally? Because that hasn't happened at least this week.
Hi. Yes, sir, this week has been a pleasant surprise, frankly. I mean, if we were to go back to Monday and see all the discussions that were happening on TV, you would have thought that this week we would end up down at least 3 to 5%, but that hasn't happened, and we have held up quite well. Probably that's a function of the structure of the Indian markets. On one hand, while we do get impacted by global volatility and flows, we do have a significant good section of the market, which is the IT, pharma, and the other exporter segments, which actually benefit from a weakening currency. So we've kind of partly built in a hedge to our markets, and that's the reason why I think the markets have been quite resilient in spite of all the negatives that we talked about, whether it's the Turkey issue or the big number on trade account deficit that we saw for India. And the fact that oil is still at 70 plus levels. In spite of all this, I think we have held up quite well.
So where are we headed? I mean, we are holding up well. Are we going to continue to hold up well, Mihir? At the margin, is something going to change? What's your assessment?
So that's a very important question, because on one hand, as you just mentioned, we are seeing a lot of outflows from emerging markets, and as you again mentioned, emerging market index is at a low and is already in bear market territory. For India to sustain against that kind of a headwind, I think it requires a lot of continuation of the local flows that we've seen over the last 1.5 years. I think even as we speak, yesterday there was decent FII selling, and of course locals are still buying. So we need this local sustenance for the markets to hold up, else we might be in for a bit of a correction.
Okay. Mihir, now in terms of themes, the one big talking point over the last 1 month is the resurgence of corporate sector, corporate-facing banks, and even PSU banks for that matter. Now, are you a believer in this move, or is this just a mere trading rally, you would say?
I would bet more on the private sector corporate banks rather than the PSU banks. My view is that the PSU banks probably still have some way to go in terms of NPA recognition, and more importantly, we still don't have visibility of growth capital for those banks. So I think they'll be on a slow path, slow burner for quite some time as far as potential for growth is concerned and the recognition of NPA is concerned. The private sector corporate banks are going to rebound much faster.
So what is the prudent way to approach the market? If you have the ability to do that, if you're an institutional money manager, then you sort of move from one thing to the other. What you consider overvalued, you move into something which you consider undervalued, and that kind of thing. But you've got to be in the market. For somebody with, I mean, a lot of our viewers will not have that constraint. What would your advice be, Mihir?
The advice would be to stick to the systematic asset allocation that you have planned for yourself over the longer term, because India has seen these kind of cycles and this kind of volatility many times, so it's not new. So instead of trying to time too much, I think stick to a large cap or a multi cap strategy, probably not so much on the mid and small cap strategy at this point in time.
In terms of themes, what is it that you like the most in the market now, Mihir? You mentioned private sector banks. What else is sort of top of mind for you?
So the delta that we have made over the last few months is basically a bit on the currency and the US strength, which is the IT sector. So last year, most of last year we were underweight on the IT segment. But given the resilience of the US economy and the upgrades to US GDP growth that we are seeing, we did see a case for fundamental growth of business for the IT segment. And in the last few months, the weakness of the currency or the strength of the dollar, depending on which way you look at it, I think has only strengthened the case for IT. So from underweight, we have switched our stance to overweight on IT. On pharmaceuticals, while we continue to be underweight, we have reduced the underweight positions a little bit, again because of the tailwinds of currency. And this has been probably at the expense of the industrials segment, where we thought valuations are kind of getting there, and maybe incremental good news, maybe kind of reducing given the fact that we are in the last year of this government, and probably we'll see more action on the rural populist side rather than on the infrastructure segment. So that's the delta that we have made to the portfolio. Otherwise, we continue to remain bullish on consumption.
Okay. So I mean, it's IT, it's pharma, it's consumption. I mean, what about? And you mentioned briefly about banks, right? I mean, those are the broad pillars of your investment sort of strategy right now.
Correct. Banks and NBFCs, as I said, banks are also the private sector banks also are directly or indirectly linked to consumption. So are the NBFCs. So I think it's a kind of a double play there.
Okay. In consumption, sort of, I mean, how are you breaking it down? Because stocks are not cheap. Across the board, we're looking at multiples in 50s, 60s, 70s. So how are you breaking this down, and what would you still buy at these elevated prices?
So consumption as a broad theme obviously has a lot of components. So automobiles is one. The private sector, NBFCs and banks are another. FMCG is another, and of course, while valuations are not that great as you mentioned, the thing is that in these volatile times, we have seen that quality and visibility of earnings does command a premium, and the premium has kept on expanding. And it's not only happened this year. This is a phenomenon that we've seen over the last 5 years, where the premium for quality and visibility has only expanded and continued to expand. So while we are not absolutely comfortable holding this, we are still there in this segment. I think the way to look at the overall picture is that on one hand you have the big thrust on consumption by the government, which helps all these segments that we talked about, whether it's FMCG, consumer discretionary, even to some extent financials, etc. But on the other hand, this consumption is not being supported by local manufacturing. So you have the trade deficit which is widening because of this lot of consumption. And this is impacting the currency, and that's where you go and play the currency sensitives like IT and pharma. So I think that's the broad situation where you have strong consumption, but also that consumption is driving the trade deficit and current account deficit. So you kind of play the hedge against that also. So it's a bit of a funny situation here.
Mm-hmm. I'm just going to come back to the point that we began with, Mihir. Are you feeling a bit of some disquiet as far as the market itself is concerned? And it goes back to the point about, you said, well, your point made absolute sense, which is at no point trying to time the market, stick with systematic investment plans. But is there a disquiet? I mean, this thing, emerging markets, the index itself down some 23, 24%. I mean, it's starting to look a bit muddy, even though, as I pointed out, I mean, the big US market continues to be on track to sort of go to an all-time high. Tough to kind of sort of tie all of this together into a coherent view for the coming week or maybe even the coming month. But what's your sense?
So, as you almost mentioned, it's actually the situation is evolving into the US and the US dollar versus the rest of the world. So you have the US equity markets at near all-time highs, the US dollar strengthening, and you are seeing Europe weakening, emerging markets weakening, Japan weakening, even China is weakening. Chinese markets are also at new 52-week lows in certain segments. So it's actually becoming, the US accelerating and extracting a lot of capital, and rest of the world actually seeing outflows. And that's the way it's going to be for a while, because you are continuing to see upgrades to US GDP growth estimates. And in Europe and Japan, we are beginning to see some amount of tapering of GDP growth estimates and even some downgrades in certain pockets. So to that extent, I think this is a trend which will continue. And as I said, for India, it works in both ways. On one side, we have the exporters which benefit, but on the other side, it may lead to higher interest rates, which can actually derail the nascent growth that we are beginning to see. So I think it's time to be a little bit wary, and one needs to keep this medium-term view in mind, and one needs to keep a very strong, very, very close watch on the dollar strength and the emerging market flows.
I'm going to just kind of, expand on that, Mihir. That was my next question, that right now it's been good going last couple of months. The market is participating, even mid-caps have started to move higher. But what are these most important triggers that perhaps could kind of spoil the party? What do you think has the market priced in with respect to the rupee? So if we do see 71, 72, is that going to be a big negative trigger? And you mentioned interest rates. Do you think this market is pricing in more tightening, or will that be an added negative trigger?
So I think the market's already pricing in one more rate hike in this financial year. On the currency side, as long as the currency depreciates in a systematic way, I think it's fine, because given the structural trade and current account deficits that we run, I think a 3 to 5% depreciation annually of the rupee is a normal thing to do. I think that's necessary to adjust for the inflation rate differential and the trade deficit. It's when you get a shock like, sudden move of 1 or 2 rupees in a day, that's when the market will pause and wonder what's happening. But I think thankfully the lira has stabilized quite well in the last 3 days, and because of that, hopefully the other emerging market currencies, even including the rupee, should not move in a very sharp fashion in the coming weeks, which will impart some kind of stability. But I don't think the problem is still past us. You may see some volatility in the global and local markets in the next few weeks.
Okay, Mihir, we leave it there. Thank you very much for joining us for that conversation. Appreciate your time. Have a good weekend, and we'll see you back soon. It's time for a very quick break here, but we leave you with some market opinion that we heard through the course of the week.
Yeah, the 6-9 month view, I think there is a lot of money to be made in the corporate bank. Provision coverage ratio for most of the banks has gone up to reasonably decent levels. I would think, in most cases about 50% plus minus another 2-3 quarters, that will reach about 60-65%. After that, the loan loss provision number should logically decline, and that should result in rating of the bank. So I think it's a question of timing over here. In the next 1 or 2 weeks, I don't think much will happen. I guess till the time we have more clarity on what's happening on this whole Turkey issue and what does it mean for emerging markets.
This quarter, the numbers as far as Nifty is concerned were dragged by corporate banks and Tata Motors. So the usual set of 3-4 stocks dragging the aggregates. We have seen more downgrades than upgrades. 86 companies we have downgraded estimates by more than 3%, and only 40 companies we have raised estimates by 3%.
I think the rupee has been strengthening in real terms for quite some time. The inflation rate has been modest but slightly above world inflation rates, and as a result, the rupee needs a modest weakening over time. So I'm not too concerned about the rupee hitting an all-time low. It's more a factor of dollar strength rather than necessarily rupee weakness. But I would say that broadly, you want to look at countries with large current account deficits as well as a high level of debt.
Welcome back. You're watching Taking Stock. Let's now talk technicals. Ashwini Gujral is here with us with the view of the market. Ashwini, let's just first look at the kind of week that we've had, the one that went by. Friday, we ended fairly solid, almost getting back to the 11,500 sort of levels. So do you see blue skies ahead? How do you expect the week to start off?
Well, for the week, both on Nifty as well as Bank Nifty, closing almost at the highs of the week. That means that the week belonged to the bulls, and there's a good chance that Monday morning we gap up and cross 11,500 with some sort of a gap, and then you have short covering kicking in, and maybe the rally is able to continue even further. Given that we have somewhat of a follow through to yesterday's move on the Dow, so that way the market is not really able to move way below 11,500. That shows that possibly the selling there isn't too strong. So my sense would be that we are now opening up levels which are 11,620 and then maybe 11,750 on the Nifty. Similarly on the Bank Nifty, I think 28,500, 600 could be opening up. So that way the market remains a strong buy on dips. And the good thing here is that a lot of sectors are participating. A broad-based market is very difficult to get into a correction because something keeps pulling it up. So my sense is the corrections are likely to be shallow, and next week all dips should be bought.
Ashwini, any specific thoughts on the way mid-caps traded through the course of the week? Any thoughts on that?
See, Nifty Junior closed higher by about 400 points, and that's highly positive because these are the good quality mid-caps, the stocks which are just after the main indices. So my sense is as the Nifty gets past 11,500, there should be a strong rally even on the mid-caps, and participation should be coming back. The way this week we have dealt with corrections and bad news, it's very clear that new money is getting allocated because on another market with the kind of EM currency fall, etc., you could have done worse.
Okay, so Ashwini, then favorite themes for the coming week? What will you work with?
See, corporate lenders are coming back again, so it appears that there is allocation happening to those guys and away from HDFC Bank, HDFC and Kotak, etc. So that way, that theme continues, consumption continues, FMCG, pharma has now joined in. So across the board, there are positives. Because of the rupee weakening, these export sectors could pitch in any time. So that way, broadly, the entire market looks positive.
Ashwini, finally, as always, your trades for the coming week?
See, Hindustan Unilever is a buy with a stop of 1770, target of 1825. SBI is a buy with a stop of 297, target of 315. And Canara Bank is a buy with a stop of 272, target of 286.
Okay, all right, Ashwini. We'll wrap it up on that note then. Thank you very much for